Want financial freedom? Then stop doing the number one mistake almost everyone makes. If you're investing monthly and aiming for financial independence, the difference between stocks, mutual funds, and index funds could mean retiring decades earlier or later. I'm a college mathematics professor, and today I will show you which option gives you the strongest path to long term wealth. Let's talk about individual stocks because, yes, they sound exciting, but they're one of the easiest ways to lose money fast. Here's the truth: 92% of professional stock pickers underperform the market. These are people with teams, data, and decades of experience. If they can't beat the market, why would we expect to? The number one reason for not buying stocks to grow your wealth would be that there's no diversification. When you bet on one company, your entire portfolio depends on it. If it crashes, you crash. And companies do disappear. CNN reported that the US has lost over half its public companies since the 1990s. Here is a stock that I bought a few years back. It didn't take long for me to lose my investment. Reason number two: high chance of underperformance. Even great companies can trail the market for years. A diversified fund almost always delivers steadier, more reliable long-term returns. Reason number three: extreme volatility. Single stocks swing hard. Those drops cause panic selling, which destroys your wealth. Reason number four: way too much work. To pick winning stocks, you need constant research, financials, leadership, industry trends, competitor analysis, and even then, the pros still lose. Reason number five: higher cost. Frequent stock buying can mean extra fees, which eat into your returns and delay your financial independence. The bottom line is individual stocks look glamorous, but for young professionals building wealth, diversified funds are the smarter, calmer, and more reliable path to financial freedom. Let's break down mutual funds in plain English and whether they actually help you build wealth. A mutual fund is basically a big money pool. A professional manager takes money from thousands of investors and uses it to buy a mix of stocks, bonds, and other assets. The idea is simple. You get instant diversification, even if you're only investing a small amount. But here's where things get interesting. Professional management, but not always professional results. A fund manager decides what to buy and sell for you, but remember what we talked about earlier. 92% of professional stock pickers underperform the market. So when you invest in a mutual fund, you're often paying for a manager who statistically won't beat a basic index fund. Fees you don't see but definitely feel. Mutual funds charge management fees and operating expenses. These come out quietly in the background, but they eat into your returns every single year. And over a long investing career, fees can cost you tens of thousands of dollars. They still carry market risk. If the investments inside the fund drop, your mutual fund drops too. Diversification helps smooth the ride, but it doesn't eliminate risk. Most mutual funds don't even survive long term. This part shocks most people. About 7% of mutual funds fail every year. At that pace, more than half disappear within 10 years. And here's a real example. A report found that mutual funds launched in 2013 had only a 37% survival rate by 2023, meaning most were shut down, merged, or simply stopped performing. Here is a graph of a recent mutual fund hitting the bottom. So just like picking individual stocks, picking the right mutual fund is extremely hard. Only a small percentage beat the market, and most don't last long enough to prove themselves. Now let's talk about index funds, the simple, stress-free way most people actually build wealth. An index fund doesn't try to beat the market, it simply tracks the market, like the S&P 500, the total stock market, or the NASDAQ. Instead of a manager trying to outsmart everyone, the fund automatically buys all the companies in the index, and that one shift changes everything. Number one, they outperform most mutual funds. Here's the wild part. When you stop trying to beat the market, you usually beat the people trying to beat the market. Year after year, index funds outperform the majority of mutual funds and almost all professional stock pickers. Why? Because the market grows over time and index funds ride that growth without the human decision-making mistakes. Number two, you have extremely low fees. Index funds are cheap. There's no high-paid fund manager making constant trades, so the fees are tiny, sometimes as low as 0.03%. These low fees mean more of your money stays invested and compounds faster. Then you have built-in diversification. With a single purchase, you're instantly invested in hundreds or even thousands of companies. One company can crash and your wealth still grows. It's the easiest way to reduce risk without reducing long-term returns. They're simple, and that's their superpower. No picking stocks, no researching managers, no guessing who will outperform this year. Just automatic long term growth that historically outpaces most other strategies. Index funds are self cleansing. You can't lose. Here is how the market and index funds cleanse themselves. This box plot represents the lowest performing companies, average performing companies, and top performing companies. As the bottom performing companies fail, they get replaced by new growing companies, whereas the top performing companies have no limit on how much they can grow. This organic process is what keeps the index fund healthy. Here is Jenny's $100 a month investment inserted into an index fund that I use for growing my wealth. This fund has very low fees, and as you can see, if Jenny started investing her $100 25 years ago when the fund was created, her balance now would be $117,425. This real-life fund is outperforming the fictional 8% fund used as an example in the previous video. The median amount of savings for Americans age 60 is $100,000. Jenny already surpassed that number with just a simple behavioral change and knowing how to invest those savings. If you don't know Jenny's story, click in the upper corner to watch the video on how she is able to invest $100 by making a simple daily behavioral change. The link to that video is also in the description down below. So the bottom line is that index funds are the most reliable, beginner-friendly investment for young professionals who want to build wealth steadily and reach financial independence without spending hours analyzing stocks. Watch the next video to continue to learn more on how to build your wealth before it is too late. Remember, mathematically, time is the most important element in growing wealth. If you found this video useful, click on the like button below, leave a comment, and subscribe to my channel to learn more on how to grow your wealth with your paycheck alone. Remember, don't make others financially independent. Make yourself financially independent.